Imagine doing everything you were told was right. You studied the market, you followed experts, you watched prices rise and felt confident. And then, almost without warning, everything collapsed. Not slowly, not gently, but violently. History is full of moments where fortunes vanished in days, sometimes hours. Entire companies disappeared, entire economies froze. And what's most disturbing is this. These disasters were not caused by ignorance. They were caused by belief. Belief that risk had been eliminated. Belief that prices could only go higher. Belief that smart people were in control. Overconfidence is one of the most expensive emotions in investing. It convinces intelligent people to ignore warning signs, dismiss critics, and take risks they would normally avoid. And when confidence turns into certainty, markets tend to deliver their harshest lessons. Today, we're going to revisit the worst investing mistakes in history, not to judge the people who made them, but to understand why they happened. Because if these mistakes were made by geniuses, institutions, and entire governments, they can be made again. Every generation believes it's different. New technology arrives. New tools promise efficiency. New narratives convince investors that the old rules no longer apply. But beneath the surface, markets haven't changed at all. They are still driven by fear and greed, by imitation and emotion, by people reacting to other people. This is why studying history isn't about memorizing dates. It's about recognizing behavior. Because when you strip away the technology, the charts, and the terminology, investing mistakes follow the same structure. A good idea turns into a great story. The story turns into hype. Hype turns into overconfidence. And overconfidence eventually collides with reality. This video isn't about predicting the next crash. It's about understanding the patterns that create them. When people look back at old bubbles, they often say the same thing. How did anyone fall for that? But at the time, it never felt foolish. It felt obvious. It felt safe. It felt inevitable. That's because bubbles don't grow on stupidity, they grow on social proof. When enough people believe something, doubt feels unnecessary. When prices keep rising, caution feels irrational. And when everyone agrees, skepticism feels dangerous. This is why history repeats, not because investors are careless, but because they are human. Understanding this doesn't make you immune to mistakes, but it does make you slower, more skeptical, and more aware. And in markets, slowing down is often the difference between survival and disaster. In the early 1600s, tulips were rare and exotic in Europe. Owning one wasn't about gardening, it was about status. At first, prices rose naturally. Wealthy collectors competed. Scarcity justified higher prices. But slowly, something changed. People began buying tulips not to own them, but to resell them. Contracts were traded repeatedly, often without the buyer ever seeing the bulb. Tulips became financial instruments. As prices climbed, skepticism vanished. The higher prices went, the more logical they seemed. Until one day, buyers stopped showing up. Prices collapsed by over 90%. Contracts became worthless. Fortunes disappeared almost overnight. Tulip Mania wasn't about flowers. It was about speculation disconnecting price from reality. By the early 1700s, Britain was rising as a global power. Trade routes were expanding, empires were growing, and investors were eager to profit from it all. That's when the South Sea Company entered the scene. The company promised enormous profits from trade with South America, a region most investors knew almost nothing about. But that didn't matter. What mattered was the story. The South Sea Company didn't sell numbers, it sold hope. Its shares were aggressively promoted. Politicians supported it. Members of Parliament invested their own money. Even the royal family was involved. As prices rose, confidence exploded. People borrowed money to buy more shares. Others sold safe assets to chase the boom. Questioning the company became socially unacceptable. If everyone important believed in it, who were you to doubt it? Even Isaac Newton, one of the greatest scientific minds in history, was caught in the mania. At first he made money. Then he bought back in at higher prices. And when the bubble burst, he lost a fortune. Later, Newton famously said he could calculate the movement of the stars, but not the madness of men. The South Sea bubble collapsed not because trade was impossible, but because expectations had become completely detached from reality. By the 1920s, America believed it had entered a permanent golden age. Factories were booming, cars were everywhere, radio and electricity were transforming daily life, and the stock market seemed unstoppable. Prices rose year after year. Newspapers declared a new era where recessions were a thing of the past. Ordinary citizens poured into the market, many for the first time. But there was a hidden danger beneath the optimism: leverage. Investors could buy stocks with borrowed money, putting down only a small percentage of the total cost. As long as prices rose, this looked brilliant. But leverage doesn't care about optimism. When stock prices started slipping in late 1929, lenders demanded repayment. Investors were forced to sell. Selling pushed prices lower. Lower prices triggered more margin calls. The system collapsed under its own weight. Banks failed. Savings disappeared. Businesses shut down. Unemployment soared. The stock market crash didn't just destroy portfolios, it shattered confidence in the entire financial system and triggered the Great Depression. The mistake wasn't investing in stocks. The mistake was believing leverage removed risk instead of multiplying it. In the late 1990s, the internet changed the world, and investors knew it. Email, online shopping, digital communication, everything felt revolutionary. The problem wasn't believing the internet was important. The problem was believing every internet company was valuable. Startups with no revenue, no profits, and sometimes no real products were valued in the billions. Business plans were replaced with slogans. Traditional metrics were dismissed as old thinking. The logic was simple: growth now, profits later. As long as stock prices rose, nobody cared how companies actually made money. But markets eventually demand reality. In the year 2000, the bubble burst. More than $5 trillion in market value vanished. Entire companies disappeared. Retirement accounts were wiped out. The internet survived and thrived, but investors learned a brutal lesson. A great idea does not guarantee a great investment. Warren Buffett is known for discipline, patience, and long-term thinking. But even he made costly mistakes. In the 1990s, Buffett acquired Dexter Shoe Company, a business that appeared stable at the time. The mistake wasn't just buying the company, it was how he paid. Buffett used Berkshire Hathaway stock. As global competition increased, Dexter Shoe collapsed. The business became worthless. But the Berkshire shares Buffett gave away? They went on to be worth tens of billions of dollars. Buffett later called this one of his worst mistakes, not because he was careless, but because he underestimated how competitive forces could destroy a seemingly solid business. The lesson wasn't about intelligence. It was about humility. In 1982, Ray Dalio was absolutely convinced he was right. He predicted an economic depression and positioned his firm accordingly. He wasn't guessing, he was confident. But he was wrong. The economy recovered instead. His firm nearly collapsed. Dalio was forced to confront a painful reality. Intelligence does not equal certainty. Instead of doubling down, he changed his entire philosophy. He began building systems that actively challenged his own beliefs and encouraged disagreement. That failure became the foundation of his future success. The mistake wasn't being wrong. The mistake would have been refusing to learn. Long-term capital management wasn't run by amateurs. It was run by Nobel Prize-winning economists using sophisticated mathematical models. Their strategies worked, until they didn't. LTCM used extreme leverage, sometimes more than $100 borrowed for every dollar invested. The models assumed markets behaved rationally, but markets don't panic rationally. When unexpected events hit in 1998, correlations broke down. Small losses became enormous. The fund nearly collapsed the global financial system. The problem wasn't math. It was believing math eliminated uncertainty. By the early 2000s, a powerful belief had taken hold across the global financial system. Housing prices do not fall nationwide. This belief wasn't limited to ordinary homeowners. Banks believed it, rating agencies believed it, investors believed it, governments believed it. Because of this assumption, banks began issuing mortgages to borrowers who clearly could not afford them. These loans were then bundled together, sliced into complex financial products, and sold as safe investments. The logic sounded convincing. If one homeowner defaults, it doesn't matter, because thousands of others will keep paying. And if housing prices keep rising, even bad loans can be refinanced or sold. But this system only worked under one condition: housing prices must keep rising. When interest rates increased and homeowners began missing payments, cracks appeared. Defaults rose. Housing prices stopped climbing. Then they started falling. Suddenly, those safe financial products were exposed for what they were: collections of bad debt. Banks stopped trusting each other. Credit froze. Institutions that had existed for over a century collapsed in days. Lehman Brothers failed. Bear Stearns disappeared. Millions of people lost their jobs, homes, and retirement savings. The 2008 crisis wasn't caused by a lack of intelligence. It was caused by blind faith in a single assumption. When everyone believes something cannot fail, risk becomes invisible until it explodes. After 2008, many investors believed the system had learned its lesson. Risk controls were strengthened. Regulations increased. Transparency improved. But while the rules changed, human behavior did not. In the 2010s, a new narrative took over: growth at all costs. WeWork wasn't just a real estate company. It was marketed as a technology revolution. Despite massive losses, its valuation soared to nearly $47 billion. Investors didn't focus on profits. They focused on vision. SoftBank poured billions into startups with little oversight, believing size alone would guarantee success. Meanwhile, crypto exchanges promised decentralization, safety, and freedom from traditional finance. Once again, investors trusted narratives more than fundamentals. When reality returned, when cash ran out, governance failed, or confidence disappeared, valuations collapsed. The names were new. The story was old. Technology didn't cause these failures. Unchecked belief did. When you step back and examine every major investing disaster, a pattern becomes impossible to ignore. The assets change. The eras change. The excuses change. But the emotions remain exactly the same. Greed convinces investors that they deserve outsized returns. FOMO convinces them that waiting is dangerous. Overconfidence convinces them they understand risk better than others. And perhaps the most dangerous belief of all: this time is different. Markets are social systems. When enough people believe the same story, it becomes self-reinforcing. Prices rise, confidence grows, and doubt disappears. Until something breaks. The market doesn't punish ignorance, it punishes arrogance. Understanding psychology doesn't mean you'll never make mistakes, but it does mean you'll recognize when emotion is driving decisions instead of logic. So how do you protect yourself from repeating history? Not by predicting the future, but by preparing for uncertainty. Diversification ensures no single mistake can destroy you. Limiting leverage ensures losses remain survivable. Questioning popular narratives keeps you grounded in reality. Most importantly, focus on risk before returns. Every great investor understands this simple truth. You don't need to be right all the time. You just need to survive long enough for probabilities to work in your favor. Markets reward patience. They reward humility. They reward discipline. And they punish certainty. The worst investing mistakes in history weren't accidents. They were predictable. They were repeatable. And most importantly, they were preventable. History doesn't exist to scare investors. It exists to teach them. If you understand how bubbles form, how confidence turns into catastrophe, and how psychology shapes markets, you gain something far more valuable than tips or predictions. You gain perspective. And in investing, perspective is power. This is Just Finance, where we study the past to protect the future.